I think we're beginning to see institutions, the big institutions, beginning to move into gold. And I think to a lesser extent, silver. You look at ETF sales. I mean, GLD, suddenly, there's sort of, I think one day last week, that went up 19 tons. And people who follow these things, you can see it. So we're just beginning to see a little bit of physical demand emanating from the institutions. And I think that will build. We've yet to see very much demand from the general public. If you look at the amount of gold that is likely to be in them in the form of physical ETFs, and also maybe to an extent physical gold itself in bar form, you've probably got no more than 0.5% exposure of that 300 trillion in gold. If it's becoming the go-to place in investment terms, which I think is inevitable.
The reasons behind gold's stellar year are plentiful and interrelated. Central bank demand, a weaker dollar, President Donald Trump's tariffs, and interest rates all bear some responsibility and are expected to continue to support gold prices in the coming months. Retail investments in gold-focused ETFs have seen 7 consecutive months of inflows, and there is ample room for this trend to continue in the coming months. Institutional investors have steadily increased their long gold exposures since the April drawdown. However, positioning here is by no means stretched. Market expert and stockbroker Alasdair Macleod notes that the 1970s exposed the fatal flaw of our fiat system when gold was detached from credit and the prices of essentials, such as oil, skyrocketed. Global portfolios are sitting on a massive ticking time bomb. According to Macleod, with less than 0.5% of the world's $300 trillion in wealth in gold, any major reallocation will send prices soaring. Central banks worldwide have gradually rebalanced their reserve portfolios away from US dollars in recent years. About 25 years ago, the US dollar accounted for approximately 70% of central bank reserves. Today, it's roughly 50% on average. The euro has risen by about 20%, and many central banks have increased their gold holdings to roughly 15% of their reserves. Other currencies, such as the Japanese yen and the British pound, each make up around 5%. The central bank's rush into gold is an open secret. Concurrently, AlasdairMacleod emphasizes they are leading the shift, steadily moving reserves out of dollars, with sovereign wealth funds and major institutions following suit. For Macleod, this marks the beginning of the end for the fiat system. He notes ETFs like GLD are already showing sharp inflows, while retail investors have yet to wake up. Before we dive into Alasdair Macleod's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
A modern economy works entirely on credit. The relationship between money and credit is that money, in the form of gold, has to secure the value of credit. And if you look at all the charts, of inflation, whatever, wholesale prices, up until the early 1970s, they hardly moved at all. Prices were, they just moved along. I mean, the price of oil, for example, was fixed at something like, I think in 1949-50, at about $2.56 a barrel. I think it was something like that. It rose once, not hugely, before the Bretton Woods system was suspended by President Nixon. But after that, what happened? I mean, the price of oil exploded, and it's even been up as far as $140 a barrel. I mean, currently it's 60 odd, whatever. It's volatile. It's gone up multiple times. Why? Because the value of credit, which we measure these things in, dollar credit, what you're doing, you may think you're buying gold, but the best way to look at it is you're selling credit. You're getting out of credit. That's the thing. The purchasing power of gold, okay, it varies, but over millennia, it's pretty constant. And if you run a chart of almost any commodity priced in gold, you see it sort of goes, prices might double, they might halve, but they don't go much beyond that. And a lot of this doubling and halving is because the relationship between gold and dollars, where the whole thing is either manipulated by governments, which has been in the past, or alternatively, we have a system which believes in macroeconomics, which is complete non-science, incidentally. And if everybody believes in something, then yeah, they can shift the value of gold measured in fiat currencies, whatever, and that has been happening. So a lot of the action you see where gold, let us say, has either halved relative to oil or doubled relative to oil has been actually that action has really come out of the fiat currency side rather than the gold side. So this is the key thing. I mean, if you're building a business, you want to invest in that business. You want certainty at the end of that business because you will do your business calculation. What you're trying to calculate is, I'm going to invest in making this product. I know from my experience in this market, well, it's obviously mainly central bank buying. They're still getting out of fiat currencies, politely put, rebalancing their reserves. I think we're beginning to see institutions, the big institutions, beginning to move into gold. And I think to a lesser extent, silver. You look at ETF sales. I mean, GLD, suddenly, there's sort of, I think one day last week, that went up 19 tons. And people who follow these things, you can see it. So we're just beginning to see a little bit of physical demand emanating from the institutions. And I think that will build. We've yet to see very much demand from the general public. This doesn't surprise me because the general public are the last people to realize that it's not prices going up, but their currency going down.
Right.
Now, the moment they realize that it's their currency going down, that's when they dump it for just to get out of it. They dump it for anything they can buy. Basically, they're selling their currency rather than buying things, if you like. That's the emphasis. So central banks are already doing this with their reserves, getting out of fiat into gold. And that, I think, is gradually spreading down. You've got, obviously, sovereign wealth funds who are dealing through their central banks. So the acquisition of gold bullion by central banks is actually far greater than that recorded because they're also dealing for sovereign wealth funds, their own sovereign wealth funds, etc. That obviously goes down to funds which are very large and close to government and close to the central banks. I think the answer to this, Sandy, is that it hasn't really started yet, but it's just beginning. It's just beginning. And to put it into context, worldwide portfolios are estimated to be around about $300 trillion worth. If you look at the amount of gold that is likely to be in them in the form of physical ETFs, and also maybe to an extent physical gold itself in bar form, you've probably got no more than 0.5% exposure of that 300 trillion in gold. If it's becoming the go-to place in investment terms, which I think is inevitable, then that's going to change very, very substantially. It's going to change the price of gold measured in any fiat currency. And this is one reason why I think we're coming to the end of the fiat currency era, because the other side of an exploding gold price, as in imploding fiat currency system.
With a 90% chance of more rate cuts this year, the dollar is set to weaken against gold and other currencies. He warns that with foreigners holding over $40 trillion in U.S. assets, the dollar is dangerously exposed if a selling spree begins. The Fed is actually chasing reflation, a move Alasdair Macleod calls a clear signal of weakness in the U.S. economy. Financial markets are becoming increasingly aware that President Trump's policies are eroding the dollar's status as the world's reserve currency. This is important not just because the U.S. enjoys an exorbitant privilege, borrowing at low interest rates, running persistently large trade deficits, printing money to finance these deficits without fear of inflation, but also because the U.S. could lose. The reserve currency issuer must be a large and influential player in global trade and finance, encouraging widespread adoption. However, countries such as China, Russia, and Iran have increased their non-dollar trade, and central banks have raised their gold holdings and diversified their foreign exchange reserves. Historical patterns are repeating on a larger and more dangerous scale. Macleod highlights that today's vastly larger credit bubble is primed to burst with even greater force. He warns that with unpredictable tariffs and policy shifts, we may be facing a crisis worse than the 1929 crash, with the potential to unravel the entire fiat system. Let's get back to the interview.
What Fed did in the last week was it clearly told everybody, we're not chasing inflation, we're chasing, we're not trying to control inflation, we're trying to stimulate reflation because jobs and all that. This is quite important. And not only that, but the bets are something like 90% possibility that there will be 2 more cuts in interest rates before the year end. This is the reflation argument coming forth. Now, that is going to weaken the dollar. That is for sure. And it'll weaken the dollar against gold, which is why gold is going up at the moment. I think in the short term, it will also weaken the dollar against other currencies. The jury's out slightly, but just look at the trade-weighted index chart and you think, whoops, I don't think I'd want to own any of this. I think what would undermine the dollar is not so much, if you like, interest rate differentials with elsewhere, insofar as you can get more for the equivalent sterling bond, or you can't get more if you like if you go into yen or if you go into euros. But there is a sort of balance of risk and return in these things. And but the way it's looking, I think, is the foreigners who are massively overweight in dollars. I mean, according to the US Treasury, they own $40 trillion, which is 130% of your economy. That, I think, is the fundamental weakness that the dollar faces compared with other currencies. At some stage, and I'm surprised it hasn't really happened yet, foreigners will start selling down their dollars, selling their underlying assets, because they've got deposits, they've got T-bills, they've got corporate debt, and they've got something like 16 trillion worth of equities. This is portfolio diversification. Now, I know enough, my own experience, of portfolio diversification into foreign markets, that is only portfolio diversification when they're going up. The moment they turn south, whoops, you don't want to diversify.
You don't want to be, they come back home.
So you can see that at some stage, there is going to be a popping of the credit bubble. And I think that's not very far off. I think it could be, in fact, I'd be very surprised if it doesn't happen by this year end. We all think of anniversaries. We remember October 1987, for example.
Yeah.
We remember October, well, at least our grandparents might remember October 1929. It seems, I think the sort of psychology of it is that we all go on holiday in the summer, it's with sort of putting everything on hold and, thinking, well, going out with the children and, oh, it's so nice out there. I'm just going to lie in the deck chair, whatever. And you don't think too much about markets. But when you get back, of course, you have quarterly committee meetings, investment committee meetings in all the big firms. They'll be sitting there and they'll be looking and seeing how they have performed. They see what they have missed, and they'll be looking at gold and mines, and they'll be looking at the Magnificent Seven, and they'll be looking at macro risk and trying to take a judgment on that. And I think on balance, that's why you suddenly get a vacuum underneath the market in the last quarter of the year, if it's going to happen. Mm-hmm. So this is, I think, a very dangerous time from that point of view. Now, let me just say something about the credit bubble. We all know credit bubbles precede a collapse in markets. They fuel markets, and then you get the collapse. Going back, you had tulipomania in Holland way back in the 1700s. You had the Mississippi bubble in France, which was actually very similar to this one insofar as it was a fiat currency under John Law, who basically stopped people having gold and silver and precious things. He confiscated them. And at the same time, you had the South Sea bubble in the UK. And this was all done on credit, incidentally. It was the beginning of the goldsmiths, sort of, if you like, invented modern British banking. At that time, they found people would deposit their gold with them, and before long, certificates, sort of evidencing gold being deposited at a reliable goldsmith were changing hands in a form of payment. So it was the forerunner of checks. And it was expansion of credit that did all this. So you get a credit expansion, and that fuels a market, and then you get the collapse. Now, in 1929, we had the Roaring Twenties, credit expansion. Mm-hmm. But the other thing we had the Smoot-Hawley Tariff Act right at the top of the market, dated 1930. It was originally examined by Congress in late 1929 or mid-29, and then passed to the upper house, which finally approved it, and it was signed into law by President Hoover in I think around about April 1930. So we had the combination of the popping of a credit bubble and the Smoot-Hawley Tariff Act. Now, what have we got today? We've got a far larger credit bubble. We don't know where we are with these damn tariffs. I mean, we know that we've got the damn things, but you've got a capricious president who keeps on changing his mind and threatening, whoever he doesn't like at that particular moment with 100% tariffs or whatever. This is very disruptive and not to be ignored. So we've got a very similar situation to 1929. I don't need to remind everybody that the stock market collapsed. It lost 90% of its value. 10,000 banks went out of business, which was actually why money supply contracted, because money supply contracts basically when credit is extinguished by...
Right.
Yeah. And it led to the end of the old gold standard in 1934 rather, at 20.67, which persisted all the way since the mid-1800s, de facto, but de jure from the Gold Act in 1900. So that was major. This one is bigger. It is bigger than 1929.
Based on recent analyses and forecasts, gold prices are expected to continue rising in the medium to long term, reaching new highs by 2025 and beyond. Gold is currently trading near all-time highs and closed at $3,815.7 on Tuesday. Analysts suggest a potential pullback in the short term, but the longer-term outlook remains bullish. Ongoing global tensions and economic uncertainty are driving investors towards gold as a safe haven asset. Are we simply seeing another market rally or the beginning of the end for the dollar's dominance? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.